Question 1. The review process indicates a potential breach of data privacy regulations concerning customer information handled by a specific department. The head of that department has suggested a swift, informal resolution to avoid disruption and potential negative publicity, proposing to address the issue internally without formal reporting. What is the most appropriate course of action for the compliance officer in this situation? Option A. Advise the head of department to rectify the issue discreetly and ensure no further records of the incident are kept to prevent future scrutiny. Option B. Accept the head of department's assurance and monitor the situation informally to avoid unnecessary escalation and administrative burden. Option C. Immediately implement disciplinary measures against the individuals involved based on the initial report, without a full investigation. To send a strong message about compliance, Option D. Initiate a formal, documented investigation involving the legal and compliance departments to assess the breach, its impact, and ensure adherence to all relevant data protection laws and internal policies. Correct answer is D. Initiate a formal, documented investigation involving the legal and compliance departments to assess the breach, its impact, and ensure adherence to all relevant data protection laws and internal policies. Explanation: this scenario is professionally challenging because it requires balancing the company's commercial interests with its stringent regulatory obligations. The compliance officer must navigate potential conflicts of interest and ensure that all actions taken are fully compliant with the CK Hutchison Holdings' internal policies and the relevant regulatory framework, which in this context is assumed to be the UK's regulatory environment as overseen by bodies like the FCA and ICO, given the nature of the company. The need for absolute priority of regulatory compliance means that any perceived benefit to the business must be secondary to adherence to the law and ethical standards. The correct approach represents best professional practice because it prioritizes a thorough, documented, and independent investigation into the potential breach. This aligns with the principles of good corporate governance and regulatory oversight. Specifically, it demonstrates a commitment to transparency, accountability, and due diligence. By involving the legal and compliance departments, the company ensures that the investigation is conducted with the necessary expertise and impartiality, adhering to principles of fairness and procedural justice. This proactive and structured response minimizes the risk of further regulatory breaches, reputational damage, and potential sanctions. It also establishes a clear audit trail, which is crucial for demonstrating compliance to regulators. An incorrect approach that involves immediate dismissal without a proper investigation fails to uphold the principles of natural justice and due process. It could lead to wrongful dismissal claims and demonstrate a disregard for employee rights, potentially violating employment law and company policy. Another incorrect approach, such as attempting to conceal the potential breach to avoid negative publicity, constitutes a serious regulatory and ethical failure. This is a direct violation of transparency requirements and could be interpreted as obstruction of regulatory oversight, leading to severe penalties. Furthermore, it erodes trust within the organization and with external stakeholders. An approach that involves a superficial review or relies solely on informal assurances without documented evidence would also be professionally unacceptable. This lacks the rigor required for effective compliance management and leaves the company vulnerable to undetected or unaddressed risks, failing to meet the standards expected by regulators for robust internal controls. Professionals should employ a structured decision-making process that begins with identifying the potential issue and its regulatory implications. This should be followed by an assessment of the severity and scope of the potential breach. The next step involves consulting relevant internal policies and external regulations. A key element is to seek advice from the appropriate internal departments, such as legal and compliance, to ensure a comprehensive and compliant course of action. Documentation at every stage is critical. Professionals should always prioritize ethical conduct and regulatory adherence over short-term commercial gains or the avoidance of immediate discomfort. Question 2. The analysis reveals that a proposed infrastructure project for CK Hutchison Holdings presents a potential conflict between significant cost savings and the risk of environmental degradation in a sensitive ecological zone. The project promises substantial short-term financial gains, but requires the clearing of a small area of protected woodland. The decision-maker must weigh the financial imperative against potential regulatory breaches and ethical responsibilities. Which of the following approaches best reflects a robust decision-making framework in this context? Option A. Proceed with the project, implementing minimal mitigation measures for the woodland, and focus on maximizing the immediate financial returns to shareholders. Option B. Conduct a thorough environmental impact assessment, consult with relevant regulatory bodies and local community representatives, and explore alternative project designs or locations that minimize ecological harm while still aiming for commercial viability. Option C. Halt the project immediately due to the potential environmental impact, regardless of the financial benefits or the possibility of alternative, less impactful solutions. Option D. Delegate the decision to a lower-level manager to avoid personal responsibility for any negative outcomes, focusing solely on the project's projected profitability. The correct answer is A. Proceed with the project, implementing minimal mitigation measures for the woodland, and focus on maximizing the immediate financial returns to shareholders. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between maximizing shareholder value and adhering to ethical considerations and regulatory compliance. The pressure to achieve short-term financial gains can often obscure the long-term implications of decisions, particularly when those decisions involve potential environmental impact or community well-being. The role of a decision-maker in such a situation requires a robust framework that balances financial objectives with broader stakeholder interests and legal obligations. The complexity arises from the need to interpret and apply relevant regulation, assess potential risks and benefits, and make a judgment call that is both commercially sound and ethically defensible. Correct approach analysis. The correct approach involves a comprehensive assessment that prioritizes regulatory compliance and ethical considerations alongside financial viability. This means thoroughly investigating the environmental impact, consulting with relevant stakeholders, including local communities and environmental agencies, and exploring alternative, less impactful solutions. Adhering to the principles of corporate social responsibility and good governance, as often mandated or encouraged by regulatory bodies like the Financial Conduct Authority, FCA, in the UK, is paramount. This approach ensures that the company operates within legal boundaries, mitigates reputational risk, and fosters sustainable long-term value creation, which aligns with the expectations of a responsible listed entity. Incorrect approach is analysis. One incorrect approach would be to solely focus on the immediate cost savings and potential revenue increase without adequately assessing the environmental risks or regulatory requirements. This could lead to violations of environmental protection laws, resulting in significant fines, legal action, and severe reputational damage. Another incorrect approach would be to proceed with the project based on a superficial understanding of the environmental impact, assuming that minor mitigation efforts will suffice. This demonstrates a failure to conduct due diligence and a disregard for the precautionary principle, which is often embedded in environmental regulation. A third incorrect approach would be to prioritize the interests of a specific group of shareholders over the broader implications for the environment and community, ignoring potential long-term liabilities and ethical duties. This contravenes principles of stakeholder engagement and responsible business conduct. Professional reasoning. Professionals should employ a structured decision-making framework that begins with identifying the core issue and its potential impacts. This involves gathering all relevant information, including legal and regulatory requirements, environmental assessments, and stakeholder perspectives. The next step is to identify and evaluate alternative courses of action, considering their feasibility, risks, and benefits. Crucially, this evaluation must incorporate ethical considerations and regulatory compliance as non-negotiable criteria. Professionals should then select the option that best balances financial objectives with legal and ethical responsibilities, documenting the rationale for their decision. Regular review and adaptation of decisions based on new information or changing circumstances are also essential components of sound professional judgment. Question 3. Compliance review shows that a significant number of new client onboarding processes are being completed with minimal verification of identity documents, relying heavily on client self-attestation. Furthermore, clients flagged as potentially high risk due to their business sector are not consistently subjected to enhanced due diligence (ED) procedures. What is the most appropriate course of action to rectify these compliance deficiencies? Option A. Immediately halt all new client onboarding until a comprehensive review and retraining of staff on UK money laundering regulations 2017 and FCA requirements for customer due diligence and EDD is completed. Option B. Instruct the compliance team to conduct a retrospective review of all onboarded clients and apply EDD only to those who exhibit suspicious activity post-onboarding. Option C. Update the client onboarding checklist to include a note about the importance of verification, but allow relationship managers discretion in applying EDD based on their judgment. Option D. Implement a policy allowing for a grace period for existing clients to provide missing verification documents while continuing to onboard new clients with the current, less stringent process. The correct answer is A. Immediately halt all new client onboarding until a comprehensive review and retraining of staff on UK money laundering regulations 2017 and FCA requirements for customer due diligence and EDD is completed. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between business objectives and regulatory obligations. The need to quickly onboard new clients while ensuring robust anti-money laundering (AML) checks creates a tension that requires careful judgment. Failing to adequately verify customer identities can expose the firm to significant legal, financial, and reputational risks, including potential fines and sanctions. Correct approach analysis. The correct approach prioritizes adherence to the UK's Money Laundering Regulations 2017, MLR 2017, and the Financial Conduct Authority's FCA Conduct of Business Sourcebook (COBS). Specifically, it aligns with the requirements for customer due diligence (CDD) and ongoing monitoring. By implementing a risk-based approach that includes enhanced due diligence (ED) for high-risk clients and utilizing reliable, independent sources for verification, the firm demonstrates a commitment to regulatory compliance and mitigating financial crime risks. This proactive stance protects both the firm and the integrity of the financial system. Incorrect approaches analysis. One incorrect approach involves relying solely on self-declaration from clients without independent verification. This directly contravenes MLR's 2017, which mandate that firms obtain and verify customer identity using reliable, independent source material. This failure exposes the firm to the risk of onboarding individuals involved in illicit activities, leading to potential breaches of AML regulations and significant penalties. Another incorrect approach is to bypass EDD for clients identified as high risk, perhaps due to their geographic location or business activities. This is a clear violation of the risk-based approach mandated by MLR's 2017 and FCA guidance. High-risk clients require more stringent checks to mitigate the increased potential for money laundering or terrorist financing. Neglecting EDD in such cases is a serious regulatory and ethical lapse. A third incorrect approach is to delegate the entire CDD process to junior staff without adequate training or oversight. While delegation can be efficient, it must be accompanied by robust training on AML regulations and internal policies, as well as effective supervision. Inadequate training can lead to errors in verification and risk assessment, undermining the effectiveness of the compliance program and potentially leading to regulatory breaches. Professional reasoning. Professionals should adopt a decision-making framework that begins with a thorough understanding of applicable regulations, MLR 2017, FCA Handbook. This should be followed by a risk assessment of the client and their proposed activities. Based on this assessment, appropriate CDD measures, including EDD where necessary, should be applied. Regular training and ongoing monitoring of compliance processes are crucial. In situations of conflict between business expediency and regulatory requirements, the regulatory obligation must always take precedence. Question 4. Governance review demonstrates that a senior executive has proposed a radical, albeit potentially lucrative, shift in the company's core business strategy, citing an immediate market opportunity. The executive is advocating for rapid approval and implementation, bypassing the usual multi-stage strategic planning and approval process to capitalize on the perceived time-sensitive advantage. What is the most appropriate course of action for the governance committee to take in response to this proposal? Option A. Delegate the decision-making authority to a newly formed ad hoc committee without providing specific guidance on the review parameters. Option B. Initiate a comprehensive review of the proposal, including its strategic alignment, financial viability, risk assessment, and compliance with all relevant regulations and internal policies. Before making any decision, Option C. Reject the proposal outright due to its deviation from established strategic planning processes and the potential for disruption. Option D. Immediately approve the proposal to seize the market opportunity, relying on the executive's judgment and the urgency of the situation. The correct answer is B. Initiate a comprehensive review of the proposal, including its strategic alignment, financial viability, risk assessment, and compliance with all relevant regulations and internal policies before making any decision. Explanation. Scenario analysis. This scenario presents a professional challenge where a senior executive, acting on perceived urgency and without full due diligence, proposes a significant strategic shift. The challenge lies in balancing the need for swift decision-making with the imperative of robust governance and adherence to established protocols. The executive's seniority and the perceived urgency can create pressure to bypass standard procedures, making it difficult to challenge the proposal directly. Careful judgment is required to ensure that strategic decisions are not only timely, but also well-informed, compliant, and aligned with the company's long-term interests and regulatory obligations. Correct approach analysis. The correct approach involves initiating a formal review process that includes a thorough assessment of the strategic proposal's implications, potential risks, and alignment with CK Hutchison Holdings' existing governance framework and regulatory compliance requirements. This approach upholds best professional practice by prioritizing due diligence, stakeholder consultation, where appropriate, and adherence to established decision-making pathways. It ensures that decisions are based on comprehensive analysis rather than immediate pressure, thereby mitigating risks and promoting sustainable growth. This aligns with the principles of good corporate governance, which emphasize transparency, accountability, and informed decision-making, as often reinforced by regulatory bodies and industry best practices. Incorrect approaches analysis. One incorrect approach involves immediately approving the proposal based on the executive's authority and the perceived urgency. This fails to adhere to the company's governance framework, potentially leading to poorly considered decisions with significant financial or reputational consequences. It bypasses essential risk assessment and due diligence, which are critical for regulatory compliance and responsible business conduct. Another incorrect approach is to dismiss the proposal outright without any form of review, simply due to its unconventional nature or the perceived disruption it might cause. This stifles innovation and can lead to missed opportunities. It demonstrates a lack of open-mindedness and a failure to engage in constructive strategic evaluation, which is a core component of effective decision-making and can be implicitly discouraged by a culture of continuous improvement expected under many regulatory regimes. A further incorrect approach is to delegate the decision-making entirely to a subcommittee without providing clear guidelines or a defined scope for their review. This can lead to a diffusion of responsibility and an incomplete assessment, as the subcommittee may lack the necessary context or authority to make a fully informed decision. It also fails to ensure that the decision-making process is transparent and accountable to the board or senior leadership. Professional reasoning. Professionals should employ a structured decision-making framework that begins with understanding the context and the nature of the proposal. This involves identifying the stakeholders, potential impacts, and any relevant regulatory considerations. The next step is to gather information and conduct a thorough analysis, which may include risk assessments, financial projections, and legal/compliance reviews. Following this, a structured evaluation of alternatives should be undertaken. Finally, the decision should be documented, communicated, and monitored for its effectiveness, ensuring alignment with the company's strategic objectives and governance principles. This systematic approach ensures that decisions are not only effective, but also defensible and compliant. Question 5. During the evaluation of a potential investment opportunity that promises unusually high returns, a junior analyst presents preliminary data suggesting a significant market inefficiency. The senior manager is aware of the firm's quarterly performance targets and the need to demonstrate strong results. The manager must decide whether to proceed with a deeper investigation or to dismiss the opportunity based on its speculative nature. Which of the following represents the most prudent and ethically sound decision-making approach? Option A. Rely on the analyst's enthusiasm and the potential for quick profits, authorizing a significant investment without further independent verification to capitalize on the perceived market inefficiency. Option B. Defer the decision until after the quarter ends, as focusing on speculative opportunities might distract from achieving the firm's current, more predictable financial goals. Option C. Immediately initiate a comprehensive due diligence process to verify the analyst's findings and assess all associated risks and potential rewards, irrespective of short-term performance pressures. Option D. Proceed with a moderate investment based on the analyst's initial findings, assuming the high returns will compensate for any unforeseen risks to meet immediate performance targets. The correct answer is C. Immediately initiate a comprehensive due diligence process to verify the analyst's findings and assess all associated risks and potential rewards, irrespective of short-term performance pressures. Explanation: this scenario presents a professional challenge due to the inherent conflict between immediate financial gain and long-term ethical considerations and regulatory compliance. The pressure to meet short-term targets can lead to overlooking potential risks or engaging in practices that, while not explicitly illegal, could damage the firm's reputation and client trust. Careful judgment is required to balance business objectives with the fiduciary duties owed to clients and the integrity of the financial markets. The correct approach represents best professional practice because it prioritizes a thorough, objective assessment of all available information before making a decision. This aligns with the principles of due diligence and responsible decision-making expected of professionals in the financial services industry. It ensures that decisions are informed, defensible, and in the best interest of all stakeholders, including the firm and its clients, while adhering to the spirit and letter of regulatory requirements. This methodical approach minimizes the risk of unintended consequences and reputational damage. An incorrect approach that focuses solely on the potential for immediate profit without considering the underlying risks or the source of the information is professionally unacceptable. This demonstrates a failure to exercise due diligence and a disregard for the potential for market manipulation or insider trading, which are serious regulatory and ethical violations. Another incorrect approach that relies on anecdotal evidence or the opinions of less experienced colleagues without independent verification shows a lack of critical thinking and a failure to uphold professional standards of research and analysis. This can lead to decisions based on flawed premises, exposing the firm and its clients to undue risk. An approach that prioritizes speed over accuracy and thoroughness, especially when dealing with significant financial decisions, is also problematic. It suggests a lack of commitment to the rigorous standards required in financial services and can result in overlooking crucial details that could have material implications. Professionals should employ a structured decision-making framework that includes clearly defining the problem or decision to be made, gathering all relevant information from reliable sources, identifying and evaluating potential options and their consequences, consulting with appropriate colleagues or supervisors when necessary, making a reasoned decision based on the analysis, and documenting the decision-making process. This framework ensures a systematic and ethical approach to complex situations. Question 6. The risk matrix shows a moderate likelihood of a significant operational disruption due to an outdated IT system, with a potential for substantial financial loss and reputational damage. The IT department proposes an immediate, albeit costly, upgrade to mitigate this risk, while the finance department suggests a phased approach involving minor patches and deferring the full upgrade to align with the next budget cycle, citing immediate cost pressures. Option A. Prioritize the immediate, comprehensive IT system upgrade to proactively address the identified moderate to high risk, ensuring business continuity and protecting against potential significant financial and reputational damage, even if it requires reallocating immediate budget resources. Option B. Delay any decision until further data is available on the exact probability and impact of the operational disruption, as the current risk matrix information is deemed insufficient for a definitive course of action. Option C. Conduct a detailed cost-benefit analysis of both the immediate upgrade and the phased approach, incorporating expert opinions and scenario planning to determine the option that best balances risk mitigation with financial prudence, and present findings to senior management for a final decision. Option D. Implement the finance department's phased approach, focusing on minor patches and deferring the full upgrade to the next budget cycle, as the immediate cost savings are a higher priority given current financial constraints. The correct answer is A. Prioritize the immediate, comprehensive IT system upgrade to proactively address the identified moderate to high risk, ensuring business continuity and protecting against potential significant financial and reputational damage, even if it requires reallocating immediate budget resources. Explanation: this scenario presents a professionally challenging situation because it requires balancing immediate operational needs with long-term strategic implications and regulatory compliance. The decision maker must assess not only the likelihood and impact of the identified risks, but also the potential for unintended consequences and the ethical considerations of their chosen course of action. The pressure to deliver results quickly can often lead to shortcuts that may compromise thoroughness and adherence to established frameworks. The correct approach represents best professional practice because it prioritizes a structured, evidence-based decision-making process aligned with the principles of good governance and risk management. By systematically evaluating the identified risks against strategic objectives and considering the potential impact on stakeholders, this approach ensures that decisions are not only effective in the short term, but also sustainable and compliant with regulatory expectations. This aligns with the C.K. Hutchison Holdings' commitment to responsible business practices and adherence to relevant financial regulations, which mandate robust risk assessment and mitigation strategies. An incorrect approach that focuses solely on the immediate cost savings without a comprehensive risk assessment fails to acknowledge the potential for significant future financial and reputational damage. This could lead to regulatory breaches if the unmitigated risks materialize, resulting in fines, sanctions, and loss of investor confidence. Another incorrect approach that prioritizes speed of execution over thoroughness ignores the fundamental principle of due diligence. This can result in overlooking critical control weaknesses or compliance gaps, exposing the company to operational failures and regulatory scrutiny. A third incorrect approach that relies on anecdotal evidence or personal intuition rather than data-driven analysis is inherently unreliable and unprofessional. It bypasses the established decision-making framework and increases the likelihood of making suboptimal or even detrimental choices, potentially violating ethical standards and regulatory requirements for objective decision-making. Professionals should employ a decision-making framework that begins with clearly defining the problem and objectives. This is followed by gathering relevant information, including data from the risk matrix and other sources. Next, potential options should be identified and evaluated against established criteria, such as strategic alignment, financial impact, operational feasibility, and regulatory compliance. The risks and benefits of each option must be thoroughly assessed, and the chosen option should be documented with a clear rationale. Finally, a plan for implementation and ongoing monitoring should be established to ensure the decision's effectiveness and to adapt to changing circumstances. Question 7. Benchmark analysis indicates that a significant player in the telecommunications sector is considering a strategic acquisition of a smaller, innovative technology firm that provides a complementary service. While the acquisition could enhance service offerings and potentially lead to greater efficiencies, there is a concern that the combined entity might gain a dominant position in a specific niche market, potentially stifling competition and impacting consumer choice. Given the regulatory environment governing mergers and acquisitions in the United Kingdom, which approach best ensures compliance with competition law and upholds ethical business practices. Option A. Conduct a brief market analysis and proceed with the acquisition, assuming that the niche market is too small to attract significant regulatory attention. Option B. Undertake a limited internal review and only engage with the CMA if specific concerns are raised by competitors or consumer groups post-acquisition. Option C. Proceed with the acquisition immediately, relying on internal legal assessments to manage any potential future regulatory challenges. Option D. Initiate a formal merger control notification process with the Competition and Markets Authority, CMA, and seek pre-merger clearance before completing the transaction. The correct answer is C. Proceed with the acquisition immediately, relying on internal legal assessments to manage any potential future regulatory challenges. Explanation: scenario analysis. This scenario presents a professional challenge due to the inherent conflict between a company's desire to expand its market presence and the stringent regulatory requirements designed to prevent anti-competitive practices. The challenge lies in interpreting and applying complex competition law to a novel business model, requiring a nuanced understanding of market definition, dominance, and potential harm to consumers. The pressure to innovate and gain first-mover advantage must be balanced against the imperative to comply with the law, demanding careful judgment and a proactive approach to regulatory engagement. Correct approach analysis. The correct approach involves a thorough and proactive engagement with the relevant competition authorities. This demonstrates a commitment to regulatory compliance and a willingness to address potential concerns transparently. By seeking pre-merger clearance or informal guidance, the company is not only seeking to ensure its proposed acquisition aligns with competition law, but also to mitigate future legal risks and potential penalties. This approach embodies best professional practice by prioritizing legal certainty and ethical conduct over a potentially risky, unilateral implementation of the strategy. It reflects an understanding that robust competition law frameworks, such as those enforced by the Competition and Markets Authority, CMA, in the UK, are designed to protect market fairness and consumer welfare, and that proactive consultation is the most responsible way to navigate these regulations. Incorrect approach is analysis. Proceeding with the acquisition without seeking regulatory approval, assuming the market impact will be negligible, represents a significant regulatory and ethical failure. This approach disregards the fundamental principles of competition law, which often require notification for mergers that meet certain thresholds or could potentially lessen competition. It demonstrates a lack of due diligence and a potentially willful blindness to legal obligations, exposing the company to substantial fines, divestment orders, and reputational damage. Relying solely on internal legal counsel's opinion without seeking external validation or formal regulatory input is also a flawed approach. While internal counsel provides valuable advice, competition law can be highly complex and fact-specific. Over-reliance on internal assessment without external confirmation or formal clearance can lead to misinterpretations of the law or an underestimation of the regulatory authority's perspective. This can result in a breach of regulatory requirements, even if unintentional. Engaging in a wait-and-see approach, where the company proceeds with the acquisition and only addresses regulatory concerns if they arise, is another ethically and legally unsound strategy. This reactive stance demonstrates a disregard for the preventative nature of competition law and the potential for significant harm to the market during the interim period. It invites regulatory scrutiny and penalties, and it fails to uphold the professional responsibility to act with integrity and foresight. Professional reasoning. Professionals facing such a scenario should adopt a structured decision-making process. First, they must thoroughly understand the relevant competition law framework applicable to their jurisdiction, in this case, UK competition law. Second, they should conduct a comprehensive internal assessment of the proposed transaction's potential impact on competition, market share, and consumer welfare. Third, they should consult with experienced external legal counsel specializing in competition law to validate their internal assessment and advise on the appropriate regulatory engagement strategy. Fourth, they should proactively engage with the relevant competition authority, whether through formal notification, informal guidance, or pre-merger clearance applications, depending on the specifics of the transaction and regulatory thresholds. This process prioritizes legal compliance, ethical conduct, and the long-term sustainability of the business. Question 8. Regulatory review indicates that CK Hutchison Holdings is considering a significant acquisition in a new international market. The target market has a robust and evolving regulatory framework concerning antitrust laws, data privacy, and consumer protection, which differs substantially from the company's primary operating jurisdictions. What is the most prudent and compliant approach for CK Hutchison Holdings to undertake before finalizing the acquisition and commencing operations in this new market? Option A. Focus primarily on the commercial and financial due diligence aspects of the acquisition, deferring detailed regulatory compliance planning until after the transaction is complete and initial operational integration has begun. Option B. Conduct a thorough, jurisdiction-specific regulatory impact assessment. Engage specialized local legal counsel to interpret and advise on all applicable laws and guidelines, and develop a comprehensive compliance integration plan that addresses potential regulatory hurdles and outlines mitigation strategies. Option C. Proceed with the acquisition based on the assumption that existing compliance policies and procedures from other markets will be largely transferable and address any specific regulatory issues that arise post-acquisition. Option D. Prioritize the speed of the acquisition and market entry, relying on internal legal teams to perform a cursory review of the target market's regulations, with a plan to seek external advice only if regulatory challenges become significant. The correct answer is B. Conduct a thorough, jurisdiction-specific regulatory impact assessment. Engage specialized local legal counsel to interpret and advise on all applicable laws and guidelines, and develop a comprehensive compliance integration plan that addresses potential regulatory hurdles and outlines mitigation strategies. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent tension between a company's strategic growth objectives and the stringent regulatory requirements for market entry. CK Hutchison Holdings, as a global entity, must navigate diverse and often complex regulatory landscapes. The challenge lies in balancing the desire for rapid expansion with the imperative to comply with all applicable laws and guidelines, particularly concerning competition and consumer protection, without compromising ethical standards or long-term business sustainability. A hasty or incomplete approach to regulatory compliance can lead to significant financial penalties, reputational damage, and operational disruptions. Correct approach analysis. The correct approach involves a comprehensive and proactive engagement with the relevant regulatory bodies. This means conducting thorough due diligence on the target market's regulatory framework, including competition law, data privacy, and consumer protection regulations. It necessitates seeking expert legal and regulatory advice specific to the jurisdiction. Furthermore, it requires developing a detailed implementation plan that explicitly addresses how the company will meet and exceed these requirements, including robust internal controls and compliance monitoring mechanisms. This approach demonstrates a commitment to operating ethically and legally, fostering trust with regulators and consumers, and ensuring a sustainable market entry. It aligns with the principles of responsible business conduct and regulatory adherence, which are paramount in maintaining a strong corporate reputation and avoiding legal entanglements. Incorrect approaches analysis. One incorrect approach would be to proceed with market entry based on a superficial understanding of the regulatory environment, assuming that existing compliance frameworks from other jurisdictions are sufficient. This fails to acknowledge the unique legal and regulatory nuances of the new market, potentially leading to violations of local competition laws or consumer protection statutes. Such a failure constitutes a significant regulatory breach and an ethical lapse, as it prioritizes speed over compliance and demonstrates a disregard for the legal obligations of the target jurisdiction. Another incorrect approach would be to delay seeking specialized legal counsel until after the market entry has commenced, or to rely solely on internal resources without external validation. This approach is problematic because it increases the risk of overlooking critical regulatory requirements or misinterpreting complex legal provisions. It can result in unintended noncompliance, leading to investigations, fines, and potential injunctions that could halt operations. Ethically, this demonstrates a lack of due diligence and a failure to uphold the company's responsibility to operate within the bounds of the law. A third incorrect approach would be to adopt a wait-and-see attitude, hoping that any potential regulatory issues will be addressed reactively rather than proactively. This is a dangerous strategy that ignores the proactive nature of most regulatory frameworks, which are designed to prevent harm before it occurs. It can lead to significant penalties and reputational damage if the company is found to be in breach of regulations, as regulators often view reactive compliance as insufficient. This approach is ethically questionable as it places the burden of identifying and rectifying noncompliance on the regulators rather than the company itself. Professional reasoning. Professionals should adopt a structured, risk-based approach to regulatory compliance. This involves 1. Early identification of all relevant regulatory frameworks. 2. Comprehensive assessment of compliance obligations and potential risks. 3. Engagement of qualified legal and regulatory experts. 4. Development of a detailed compliance plan integrated into the business strategy. 5. Establishment of robust internal controls and ongoing monitoring. 6. Continuous engagement with regulatory bodies where appropriate. This systematic process ensures that business objectives are pursued responsibly and ethically, minimizing legal and reputational risks. Question 9. The performance metrics show a substantial rise in customer complaints regarding the clarity of terms and conditions for a recently introduced investment product. What is the most appropriate immediate course of action for the compliance department to take? Option A. Initiate a comprehensive review of the product's marketing materials, sales scripts, and customer feedback channel to identify specific areas of confusion and potential misinterpretation. Option B. Issue a company-wide memo emphasizing the importance of adhering to existing sales protocols without investigating the specific nature of the complaints. Option C. Advise the sales team to temporarily halt all sales of the product until the complaint volume subsides naturally. Option D. Focus on quantifying the financial cost of the complaints and preparing a report for senior management on potential financial liabilities. Correct answer is A. Initiate a comprehensive review of the product's marketing materials, sales scripts, and customer feedback channels to identify specific areas of confusion and potential misinterpretations. Explanation. The performance metrics show a significant increase in customer complaints related to the clarity of product terms and conditions for a new financial product launched by Hutchison Holdings. This scenario is professionally challenging because it requires balancing the company's commercial objectives with its regulatory obligations to ensure fair treatment of customers and transparency in product offerings. The pressure to meet sales targets might tempt individuals to overlook or downplay the severity of these complaints. The correct approach represents best professional practice because it prioritizes a thorough investigation into the root cause of the complaints, involving a review of the product documentation, sales scripts, and customer service interactions. This aligns with the principles of treating customers fairly, a core tenet of financial regulation, which mandates that firms must act honestly, fairly, and professionally in accordance with the best interests of their customers. Specifically, it reflects the regulatory expectation that firms proactively identify and address issues that could lead to customer detriment. This approach demonstrates a commitment to ethical conduct and robust risk management, ensuring that the company's operations are compliant and customer-centric. An incorrect approach that involves dismissing the complaints as isolated incidents without further investigation fails to uphold the duty of care owed to customers. This could lead to regulatory breaches related to mis-selling or inadequate disclosure, potentially resulting in fines and reputational damage. Another incorrect approach, which is to immediately revise the product terms without understanding the specific issues raised by customers, is inefficient and may not address the core problem, potentially leading to further customer dissatisfaction and wasted resources. It also bypasses the opportunity to improve sales processes and customer understanding, which is a key aspect of responsible business conduct. A third incorrect approach, which is to focus solely on the financial impact of the complaints without addressing the underlying customer experience, neglects the ethical imperative to provide clear and understandable financial products and services. This can lead to a perception of the company as prioritizing profit over customer well-being, which is detrimental to long-term sustainability and regulatory trust. Professionals should adopt a decision-making framework that begins with acknowledging and validating customer feedback. This should be followed by a structured investigation to identify the root cause, involving relevant stakeholders such as product development, sales, compliance, and customer service teams. The findings should then inform corrective actions, which may include revising product documentation, enhancing sales training, or improving customer communication strategies. Throughout this process, adherence to regulatory requirements and ethical principles should be paramount, ensuring that customer interests are protected and that the company operates with integrity. Question 10. Quality control measures reveal that the firm's current risk assessment process for identifying potential market manipulation activities relies heavily on automated alerts triggered by deviations from historical trading patterns. While this system flags a significant number of potential issues, there is a concern that it may be overlooking more sophisticated or novel manipulation techniques that do not leave obvious statistical footprints. Which of the following approaches would best enhance the effectiveness and compliance of the firm's risk assessment process in this context? Option A. Augment the automated alert system with a qualitative review by experienced compliance officers who can assess the context and intent behind flagged trading activities and proactively scan for emerging manipulation typologies. Option B. Implement a mandatory, in-depth manual review of every single trade executed by the firm to ensure absolute certainty. Option C. Focus solely on refining the algorithms of the automated alert system to predict future manipulation patterns based on historical data. Option D. Increase the sensitivity of the automated alert system to capture even minor deviations, thereby ensuring no potential manipulation is missed. The correct answer is A. Augment the automated alert system with a qualitative review by experienced compliance officers who can assess the context and intent behind flagged trading activities and proactively scan for emerging manipulation typologies. Explanation. Scenario analysis. This scenario presents a challenge because it requires balancing the need for timely risk identification with the potential for over-reliance on automated systems, which may miss nuanced or emerging risks. The firm must ensure that its risk assessment process is robust enough to capture both quantitative and qualitative risk factors, and that human oversight remains a critical component. The pressure to demonstrate compliance and efficiency can lead to a temptation to solely depend on technology, which is a common pitfall in risk management. Correct approach analysis. The correct approach emphasizes a blended methodology, combining automated data analysis with expert judgment. This aligns with best practices in risk assessment, which recognize that while technology can efficiently process large datasets and identify patterns, it often lacks the contextual understanding and foresight that experienced professionals possess. Regulatory frameworks, such as those overseen by the Financial Conduct Authority, FCA, in the UK, expect firms to have a comprehensive risk assessment process that is not only systematic but also adaptable to evolving threats. This approach ensures that the firm can identify a broader spectrum of risks, including those that are not easily quantifiable or that are emerging in nature, thereby fulfilling its duty of care and regulatory obligations. Incorrect approaches analysis. An approach that solely relies on automated anomaly detection systems would be professionally unacceptable. This fails to account for qualitative risks, emerging threats that may not yet manifest as statistical anomalies, and the potential for false positives or negatives generated by the algorithms. Ethically, it could lead to a failure to identify and mitigate significant risks, potentially harming clients or the firm itself. From a regulatory perspective, it demonstrates a lack of due diligence and a failure to implement a sufficiently robust risk management framework, as mandated by guidelines like those from the CISI. An approach that prioritizes manual review of all identified anomalies, regardless of their potential severity, would also be professionally inefficient and potentially ineffective. Thoroughness is important. An indiscriminate manual review of every minor anomaly would consume excessive resources and dilute the focus on genuinely material risks. This could lead to a needle in a haystack problem, where significant risks are overlooked due to the sheer volume of minor issues being examined. It fails to demonstrate a proportionate and risk-based approach, which is a cornerstone of effective risk management and regulatory expectation. An approach that focuses exclusively on historical data without considering forward-looking indicators or emerging trends would be professionally deficient. Risk assessment must be dynamic and predictive, not merely reactive. Relying solely on past events ignores the possibility of new types of risks or changes in the existing risk landscape. This approach would likely result in a failure to anticipate and prepare for future threats, leaving the firm vulnerable and potentially in breach of its ongoing duty to manage risks effectively, as expected by regulatory bodies. Professional reasoning. Professionals should adopt a structured yet flexible approach to risk assessment. This involves 1. Defining the scope and objectives of the risk assessment. 2. Identifying potential risks through a combination of data analysis, expert interviews, and scenario planning. 3. Analyzing and evaluating the identified risks based on their likelihood and impact. 4. Developing and implementing appropriate risk mitigation strategies. 5. Continuously monitoring and reviewing the risk landscape and the effectiveness of mitigation measures. This iterative process, incorporating both technological tools and human expertise, ensures a comprehensive and dynamic risk management framework. Question 11. Implementation of a new product launch by Hutchison Holdings is met with unexpected technical issues that could impact its market reception and potentially its stock price. A senior executive suggests downplaying the severity of these issues in the initial public statements to avoid negative press and allow the company time to resolve them before a full disclosure. Option A. Focus public statements solely on the product's strengths and potential, while privately informing key investors about the technical challenges to manage their expectations. Option B. Suggest that the technical issues are minor and temporary, and that the market reaction will likely be insignificant, without providing specific details about the problems. Option C. Delay the public announcement of the technical issues until a more positive spin can be developed, focusing on the product's potential benefits and minimizing discussion of the problems. Option D. Immediately report the technical issues accurately and transparently to all relevant stakeholders, including the public and regulatory bodies, while outlining a clear plan for resolution. The correct answer is D. Immediately report the technical issues accurately and transparently to all relevant stakeholders, including the public and regulatory bodies, while outlining a clear plan for resolution. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between a company's desire for positive public perception and the ethical obligation to disclose potentially negative information. The pressure to manage public relations can lead individuals to consider withholding or downplaying material facts, which directly contravenes principles of transparency and honesty. The professional's duty is to navigate this pressure while upholding their ethical responsibilities and adhering to relevant regulatory frameworks. Correct approach analysis. The correct approach involves prioritizing accurate and timely disclosure of material information, even if it might be perceived negatively by the public or stakeholders. This aligns with the fundamental ethical principles of honesty, integrity, and transparency expected of professionals. In the context of financial markets and corporate governance, this also directly supports regulatory requirements for fair disclosure and investor protection. Upholding these standards builds trust and maintains the integrity of the financial system. Incorrect approach is analysis. Withholding or selectively disclosing information to manage public perception is a failure of integrity and honesty. It can lead to accusations of market manipulation or misleading the public, violating ethical codes and potentially specific regulations concerning disclosure. This approach prioritizes short-term reputational gains over long-term trust and compliance, suggesting a delay in disclosure until a more favorable narrative can be constructed is a form of deceptive practice. It implies an intent to mislead stakeholders by presenting information in a biased manner, which is ethically unsound and can have severe regulatory consequences, including penalties for insider trading or market abuse if the delay is used to exploit information asymmetry. Focusing solely on the potential negative impact on share price without considering the obligation to inform stakeholders accurately demonstrates a disregard for professional duty and regulatory compliance. While share price is important, it is a consequence of informed market activity, not a justification for obscuring material facts. This approach prioritizes financial outcomes over ethical conduct and legal obligations. Professional reasoning. Professionals should adopt a decision-making framework that begins with identifying all relevant ethical principles and regulatory obligations. They should then assess the potential impact of different courses of action on all stakeholders, prioritizing transparency and accuracy. If faced with conflicting pressures, seeking guidance from compliance departments, legal counsel, or senior management is crucial. The ultimate decision must be defensible based on ethical standards and regulatory requirements, ensuring that all material information is disclosed in a timely and truthful manner. Question 12. The assessment process reveals that the current client onboarding procedure is significantly slower than industry benchmarks, impacting client acquisition rates. A proposal has been made to streamline the process by reducing the number of mandatory data verification steps, arguing that this will dramatically improve turnaround times and client satisfaction. Option A. Delegate the decision-making authority for waiving verification steps to junior staff members, empowering them to make on-the-spot judgments to speed up client onboarding. Option B. Implement a phased approach to process optimization, beginning with a detailed root cause analysis of current inefficiencies, followed by the development and pilot testing of revised verification protocols that maintain data integrity and compliance with relevant regulations. Before a full rollout, Option C. Automate the collection of client data without independently verifying its accuracy against source documents, relying solely on the client's input to expedite the process. Option D. Immediately reduce the number of data verification steps by 30% across all onboarding cases to achieve rapid efficiency gains, assuming that the risk of error is acceptable for the sake of speed. The correct answer is B. Implement a phased approach to process optimization, beginning with a detailed root cause analysis of current inefficiencies, followed by the development and pilot testing of revised verification protocols that maintain data integrity and compliance with relevant regulations, before a full rollout. Explanation: this scenario presents a professional challenge in balancing efficiency gains with the integrity of data and compliance with regulatory expectations for process optimization within a financial services context. As governed by the C.K. Hutchison Holdings Hiring Assessment Tests Implied Regulatory Framework, assumed to align with UK financial services regulations and SISI guidelines for the purpose of this assessment. The core tension lies in achieving faster processing times without compromising accuracy, customer data protection, or adherence to reporting standards. Careful judgment is required to ensure that any optimization does not inadvertently create new risks or violate established protocols. The correct approach represents best professional practice because it prioritizes a systematic, data-driven, and risk-aware methodology. This involves a thorough understanding of the existing process, identifying bottlenecks through objective analysis, and then proposing and testing solutions with a focus on maintaining or improving accuracy and compliance. This aligns with regulatory expectations for robust internal controls and responsible innovation. Specifically, it reflects the principles of good governance and operational resilience, ensuring that changes are well understood, validated, and do not introduce systemic risks that could lead to regulatory breaches or reputational damage. The emphasis on pilot testing and stakeholder feedback ensures that the optimized process is not only efficient, but also practical and compliant. An incorrect approach that focuses solely on speed without considering accuracy or compliance would be professionally unacceptable. This would represent a failure to uphold the duty of care owed to clients and the market, potentially leading to errors in reporting, misrepresentation of financial data, or breaches of data privacy regulations. Such an approach demonstrates a disregard for the fundamental principles of financial conduct and operational integrity, which are paramount in regulated environments. Another incorrect approach that bypasses established validation and testing procedures to implement changes rapidly would also be a significant regulatory and ethical failure. This demonstrates a lack of due diligence and a failure to adhere to internal control frameworks designed to prevent errors and fraud. It could lead to the introduction of untested vulnerabilities into critical systems, increasing the risk of operational failures and noncompliance. The professional reasoning process for similar situations should involve a structured approach. First, clearly define the problem and objectives, including desired efficiency gains and non-negotiable compliance standards. Second, conduct a comprehensive analysis of the current process, utilizing data and stakeholder input to identify root causes of inefficiency. Third, brainstorm and evaluate potential solutions, rigorously assessing their impact on accuracy, compliance, security, and customer experience. Fourth, develop a detailed implementation plan that includes robust testing, pilot phases, and clear rollback strategies. Finally, establish ongoing monitoring and review mechanisms to ensure sustained performance and compliance. This methodical approach ensures that process optimization is conducted responsibly and ethically, safeguarding the firm and its stakeholders. Question 13. The control framework reveals an opportunity to significantly streamline several back-office processes, promising substantial cost savings and improved turnaround times. However, the proposed optimizations involve changes to data handling procedures and require new software integration. Given the potential for disruption and the need to maintain regulatory compliance, which approach to implementing these process optimizations is most professionally sound? Option A. Prioritize the cost reduction aspect of the optimization by implementing the most impactful changes first, even if it means temporarily reducing the scope of quality control checks to meet initial targets. Option B. Immediately deploy the new processes across all relevant departments to achieve the projected cost savings and efficiency gains as quickly as possible, relying on on-the-job learning for staff adaptation. Option C. Initiate a pilot program in a single department to test the proposed changes, gather feedback, and refine the implementation strategy before a wider rollout, ensuring comprehensive staff training and clear communication throughout the process. Option D. Implement the changes incrementally, focusing first on the most straightforward process adjustments and deferring more complex software integrations until later to minimize initial disruption. The correct answer is C. Initiate a pilot program in a single department to test the proposed changes, gather feedback, and refine the implementation strategy before a wider rollout, ensuring comprehensive staff training and clear communication throughout the process. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires balancing the immediate need for efficiency gains with the long-term implications for operational integrity and regulatory compliance. The pressure to demonstrate rapid improvements can lead to overlooking critical control points or the potential for unintended consequences. A hasty implementation without thorough risk assessment and stakeholder consultation can undermine trust and create future remediation costs. Correct approach analysis. The correct approach represents best professional practice because it prioritizes a systematic and controlled implementation of process optimization. This involves a phased rollout, starting with a pilot program to identify and address unforeseen issues in a contained environment. It also emphasizes robust testing, comprehensive training for affected staff, and clear communication channels to manage expectations and gather feedback. This methodology aligns with principles of good governance and risk management, ensuring that efficiency gains are achieved without compromising operational effectiveness or regulatory adherence. Specifically, it reflects a commitment to due diligence and a proactive approach to managing change, which are fundamental to maintaining a sound control framework, as expected by regulatory bodies overseeing financial services operations. Incorrect approaches analysis. One incorrect approach involves immediately implementing the proposed changes across all departments without prior testing or pilot programs. This demonstrates a failure to adequately assess risks and potential disruptions. It can lead to widespread operational failures, data integrity issues, and non-compliance with reporting requirements, potentially triggering regulatory scrutiny and penalties. This approach disregards the principle of controlled change management. Another incorrect approach is to focus solely on cost reduction targets without considering the impact on the quality of service or the robustness of internal controls. This can lead to the elimination of essential checks and balances, increasing the likelihood of errors, fraud, or breaches of client confidentiality. Such a narrow focus is ethically questionable and can violate regulatory obligations to maintain adequate systems and controls. A third incorrect approach is to bypass established change management protocols and implement changes based on informal approvals or the perceived urgency. This undermines the integrity of the control framework and can create a precedent for circumventing necessary oversight. It increases the risk of unauthorized or poorly designed changes being introduced, leading to operational instability and potential regulatory breaches. Professional reasoning. Professionals should adopt a structured decision-making process that begins with a thorough understanding of the objectives and constraints. This involves identifying all relevant stakeholders, assessing potential risks and benefits, and evaluating alternative solutions against established criteria. A key step is to consult relevant policies, procedures, and regulatory guidance to ensure that any proposed changes are compliant and ethically sound. The process should include a risk assessment, a pilot phase for testing, comprehensive training, and a clear communication plan. Continuous monitoring and evaluation post-implementation are also crucial to ensure sustained effectiveness and compliance. Question 14. Market research demonstrates a growing consumer preference for sustainable and ethically sourced products. Hutchison Holdings is considering a significant diversification into a new industry sector that, while potentially lucrative, has historically faced criticism regarding its environmental impact and labor practices. How should the company best approach this strategic decision from a stakeholder perspective? Option A. Initiate discussions with key shareholders to gauge their appetite for the diversification, without engaging other stakeholder groups, as their financial investment is the primary driver of the company's strategic direction. Option B. Focus exclusively on securing the most profitable acquisition targets, with minimal consideration for the historical environmental and labor issues, as the primary responsibility of the company is to maximize shareholder value. Option C. Proceed with the diversification based on the projected financial returns, assuming that any negative stakeholder perceptions can be managed through public relations efforts after the acquisition is complete. Option D. Conduct thorough due diligence on the environmental and labor practices of potential acquisition targets within the new sector. Develop a clear plan for improving these practices post-acquisition, and proactively communicate these plans and commitments to all relevant stakeholders, including investors, employees, and consumer advocacy groups, before finalizing the diversification. The correct answer is D. Conduct thorough due diligence on the environmental and labor practices of potential acquisition targets within the new sector. Develop a clear plan for improving these practices post-acquisition, and proactively communicate these plans and commitments to all relevant stakeholders, including investors, employees, and consumer advocacy groups, before finalizing the diversification. Explanation. This scenario presents a professional challenge due to the inherent conflict between a company's strategic growth objectives and the potential impact on its diverse stakeholder groups. CK Hutchison Holdings, as a multinational conglomerate, operates across various sectors and geographies, meaning its decisions have far-reaching consequences for shareholders, employees, customers, suppliers, and the communities in which it operates. Balancing the immediate financial interests of shareholders with the long-term sustainability and ethical considerations for other stakeholders requires careful judgment and a robust understanding of corporate governance principles. The correct approach, prioritizing transparent communication and engagement with all relevant stakeholders regarding the proposed diversification strategy, represents best professional practice. This aligns with principles of good corporate governance, which emphasize accountability, fairness, and transparency. By proactively informing stakeholders about the potential benefits and risks, and by seeking their input, CK Hutchison Holdings demonstrates a commitment to responsible business conduct. This approach fosters trust, mitigates potential reputational damage, and can lead to more sustainable and widely accepted strategic decisions. It also aligns with regulatory expectations in many jurisdictions that encourage companies to consider the interests of a broader range of stakeholders beyond just shareholders, particularly in areas like environmental, social, and governance-esque reporting and responsible investment. An incorrect approach that focuses solely on maximizing immediate shareholder returns without considering the broader stakeholder impact would be professionally unacceptable. This could lead to regulatory scrutiny for failing to adhere to principles of corporate social responsibility, or for potential breaches of fiduciary duties, if the decision demonstrably harms other stakeholder groups without adequate justification. For instance, a strategy that significantly impacts employee job security or environmental standards without proper consultation or mitigation plans could attract criticism and potential legal challenges. Another incorrect approach, which involves withholding crucial information from certain stakeholder groups to gain a competitive advantage, is ethically unsound and could lead to accusations of market manipulation or insider dealing, depending on the specific information and jurisdiction. This erodes trust and can result in significant reputational and financial penalties. The professional decision-making process for similar situations should involve a comprehensive stakeholder analysis to identify all affected parties and their respective interests. This should be followed by an assessment of the potential impacts of the proposed strategy on each stakeholder group, considering both positive and negative consequences. A robust risk assessment, including reputational and regulatory risks, is crucial. The company should then develop a communication and engagement plan that is tailored to each stakeholder group, ensuring transparency and providing opportunities for feedback. Finally, the decision-making process should be documented, demonstrating due diligence and adherence to ethical and regulatory standards. Question 15. Investigation of the process for selecting a third-party vendor to manage a segment of client data processing, considering the need for cost optimization while adhering to stringent data protection and confidentiality protocols. Option A. Delegate the entire vendor selection and compliance verification process to an administrative assistant with minimal oversight to expedite the decision. Option B. Engage the vendor offering the lowest cost proposal immediately, assuming their self-declared compliance is sufficient to achieve rapid cost savings. Option C. Conduct a thorough due diligence process on potential vendors, verifying their compliance certifications, data security measures, and adherence to relevant data protection laws, alongside a review of Hutchison Holdings' internal policies on outsourcing and data handling. Option D. Proceed with a vendor based on a brief online search and a verbal assurance of compliance, without formal documentation or verification. The correct answer is C. Conduct a thorough due diligence process on potential vendors, verifying their compliance certifications, data security measures, and adherence to relevant data protection laws, alongside a review of Hutchison Holdings' internal policies on outsourcing and data handling. Explanation. Scenario analysis. This scenario presents a professional challenge involving the interpretation and application of internal company policies in conjunction with potential regulatory expectations, specifically within the context of Hutchison Holdings' operational environment. The core difficulty lies in balancing the immediate need for operational efficiency and cost saving with the imperative to maintain robust compliance and ethical standards, particularly when dealing with sensitive client data and potential conflicts of interest. The decision requires careful judgment to avoid actions that could lead to regulatory breaches, reputational damage, or internal misconduct. Correct approach analysis. The correct approach involves a thorough review of both Hutchison Holdings' internal policies on data handling, client confidentiality, and third-party vendor management, alongside any relevant regulatory guidelines applicable to the financial services sector in the relevant jurisdiction. This approach prioritizes a systematic and documented process. It ensures that any decision to outsource or delegate tasks involving client data is undertaken with full awareness of legal obligations, contractual terms, and ethical considerations. This aligns with best professional practice by demonstrating due diligence, risk management, and a commitment to regulatory compliance, thereby safeguarding client interests and the company's integrity. It also ensures that any vendor selected meets stringent security and compliance standards, mitigating potential data breaches or misuse. Incorrect approaches analysis. An approach that prioritizes immediate cost reduction by engaging a vendor without a comprehensive due diligence process, particularly one that involves handling sensitive client information, represents a significant regulatory and ethical failure. This bypasses essential risk assessment and compliance checks, potentially violating data protection regulations, e.g., GDPR if applicable, or equivalent local legislation, and internal policies designed to protect client confidentiality. It also creates a substantial risk of reputational damage and legal penalties. Another incorrect approach would be to proceed with outsourcing based solely on a vendor's self-attested compliance claims without independent verification. This demonstrates a lack of professional skepticism and due diligence, failing to meet the standards expected by regulators and clients. It exposes the company to risks associated with vendor noncompliance, data security vulnerabilities, and potential breaches of contractual obligations. Finally, an approach that involves delegating the decision-making authority for vendor selection to a junior employee without adequate oversight or clear guidelines on compliance requirements is also professionally unacceptable. This can lead to inconsistent application of policies, overlooked risks, and ultimately, noncompliance. It fails to uphold the principle of accountability and robust internal controls necessary for managing sensitive operations. Professional reasoning. Professionals facing such a situation should adopt a structured decision-making process. This begins with clearly identifying the objectives and constraints, including cost efficiency, compliance requirements, and ethical considerations. The next step involves gathering all relevant information, including internal policies, regulatory frameworks, and vendor credentials. A risk assessment should then be conducted to identify potential pitfalls associated with each viable option. Based on this assessment, the most prudent course of action, which demonstrably upholds regulatory compliance and ethical standards, should be selected. Documentation of the entire process, from initial assessment to final decision, is crucial for accountability and future reference. Question 16. What factors determine the appropriate level of due diligence to be applied during the client onboarding process for a financial services firm operating under UK regulations? Option A. The potential revenue generated by the client and the speed at which they can be onboarded. Option B. The inherent risk profile of the client and the nature of the services being provided. Option C. The firm's internal targets for client acquisition and market share growth. Option D. The client's stated business activities without independent verification. Correct answer is B. The inherent risk profile of the client and the nature of the services being provided. Explanation. This scenario presents a professional challenge because it requires a nuanced understanding of how to balance commercial objectives with the stringent regulatory requirements governing financial services, specifically in the context of client onboarding and due diligence. The pressure to onboard clients quickly for revenue generation can create a conflict with the imperative to conduct thorough know-your-customer (KIC) and anti-money laundering (AML) checks, which are critical for preventing financial crime and maintaining the integrity of the financial system. The firm's reputation and regulatory standing are at stake. The correct approach represents best professional practice because it prioritizes robust risk assessment and adherence to regulatory mandates over short-term commercial gains. This involves implementing a risk-based approach to client onboarding, where the level of due diligence is proportionate to the assessed risk of the client. This aligns with the principles of the UK's money laundering regulations, MLR, and the Financial Conduct Authority's FCA guidance, which emphasize a proactive and risk-sensitive approach to AML/KYC. Embedding these checks into the onboarding process and ensuring adequate resources and training for staff, the firm demonstrates a commitment to compliance and ethical conduct, thereby safeguarding itself and its clients from illicit activities. An incorrect approach that prioritizes speed over thoroughness, for instance, by waiving or significantly reducing due diligence for high-value clients, would represent a serious regulatory and ethical failure. This directly contravenes the MLR's and FCA principles, which mandate that all clients undergo appropriate due diligence regardless of their potential revenue contribution. Such a failure could lead to the firm being used for money laundering or terrorist financing, resulting in severe penalties, including substantial fines, reputational damage, and potential criminal charges. Another incorrect approach, such as relying solely on automated checks without human oversight for complex or high-risk clients, also fails to meet regulatory expectations. The FCA expects firms to exercise professional judgment and to escalate complex cases for further investigation, which automated systems alone cannot adequately provide. This oversight could allow sophisticated criminal schemes to go undetected. Professionals should adopt a decision-making framework that begins with a clear understanding of the relevant regulatory obligations, e.g., MLR, FCA handbook. This should be followed by a comprehensive risk assessment of the client and the proposed transaction. The firm's internal policies and procedures, which should be designed to reflect regulatory requirements, must then be applied consistently. Crucially, professionals must exercise independent judgment, escalate any identified red flags or uncertainties to senior management or compliance departments, and be prepared to decline onboarding if the risks cannot be adequately mitigated. This proactive and risk-aware approach ensures that commercial interests do not compromise regulatory compliance or ethical standards. Question 17. When evaluating the implementation of new global data privacy regulations across CK Hutchison Holdings' diverse international operations, which approach best ensures robust compliance and ethical data stewardship while managing operational complexity? Option A. Focus exclusively on meeting the lowest common denominator of data privacy regulations across all regions to minimize immediate implementation costs and operational disruption. Option B. Develop a unified global data privacy framework that adheres to the most stringent regulatory requirements found across all operating jurisdictions, supplemented by localized addenda where necessary for specific regional laws. Option C. Implement a series of distinct data privacy policies, each tailored to the minimum legal requirements of individual operating countries, without a unifying global standard. Option D. Prioritize compliance with the data privacy laws of the company's headquarters jurisdiction, assuming these will generally cover the requirements of other operating regions. The correct answer is B. Develop a unified global data privacy framework that adheres to the most stringent regulatory requirements found across all operating jurisdictions, supplemented by localized addenda where necessary for specific regional laws. Explanation. Scenario analysis. This scenario presents a challenge in implementing new data privacy regulations within a multinational corporation like CK Hutchison Holdings. The core difficulty lies in balancing the diverse legal and cultural landscapes across different operating regions with the need for a unified, compliant data handling policy. Ensuring that all subsidiaries adhere to the strictest applicable standards while also being practical and cost-effective requires careful strategic planning and robust oversight. The risk of noncompliance, leading to significant fines, reputational damage, and loss of customer trust, is substantial. Correct approach analysis. The correct approach involves a comprehensive, risk-based strategy that prioritizes the highest standards of data protection across all jurisdictions. This means identifying the most stringent regulatory requirements e.g., GDPR if applicable in any operating region, and designing a global framework that meets or exceeds these. This approach is best professional practice because it proactively mitigates risk by aiming for the highest common denominator of compliance. It demonstrates a commitment to data privacy and ethical data handling, which is increasingly important for corporate reputation and customer loyalty. This aligns with the principles of data minimization, purpose limitation, and accountability, which are fundamental to modern data protection laws. Incorrect approaches analysis. Adopting the lowest common denominator of compliance across all regions is a significant regulatory and ethical failure. It exposes the company to the risk of violating stricter laws in specific jurisdictions, leading to penalties and legal action. Ethically, it suggests a disregard for the privacy rights of individuals in regions with stronger protections. Implementing a patchwork of region-specific policies without a clear overarching framework is also problematic. This can lead to inconsistencies in data handling, increased complexity in management and auditing, and a higher likelihood of accidental noncompliance due to oversight or misinterpretation of differing rules. It fails to establish a consistent culture of data protection across the organization, focusing solely on compliance with the minimum legal requirements in each region, without considering best practices or potential future regulatory changes, is a short-sighted approach. It may satisfy current legal obligations, but leaves the company vulnerable to evolving privacy expectations and potential future enforcement action. It also misses opportunities to build stronger customer trust through superior data protection. Professional reasoning. Professionals should approach the implementation of new regulations by first conducting a thorough jurisdictional analysis to understand all applicable laws and guidelines. They should then adopt a risk-based methodology, identifying the most stringent requirements and designing a unified policy that meets or exceeds these. This should be followed by a robust implementation plan, including training, clear communication, and ongoing monitoring and auditing. Regular reviews and updates to the policy are essential to adapt to changes in regulations and best practices. The decision-making process should prioritize ethical considerations and long-term reputational health alongside legal compliance. Question 18. Examination of the data shows that CK Hutchison Holdings is implementing a new customer relationship management (CRM) system across its global operations. This system will collect and process a significant volume of personal data, including contact details, purchase history, and communication preferences. Given the company's international presence, the implementation must adhere to the General Data Protection Regulation, GDPR, where applicable, alongside any other relevant data protection frameworks. Which of the following approaches best ensures compliance with GDPR principles and fosters a culture of data privacy within the organization? Option A. Develop a comprehensive data governance framework for the CRM system that includes data minimization, purpose limitation, and clear consent management protocols, supported by a designated data protection officer and regular data protection impact assessments for high-risk data processing activities. Option B. Delegate all data protection responsibilities related to the CRM system to local legal teams in each operating region, without a centralized oversight mechanism, to ensure consistent application of GDPR principles. Option C. Prioritize the functionality and efficiency of the CRM system, assuming that compliance in the company's primary operating jurisdiction will automatically satisfy GDPR requirements in other regions. Option D. Implement the CRM system with minimal data fields initially, relying on IT to manage security, and address specific GDPR requirements only when a data subject request or a regulatory inquiry arises. The correct answer is D. Implement the CRM system with minimal data fields initially, relying on IT to manage security, and address specific GDPR requirements only when a data subject request or a regulatory inquiry arises. Explanation. Scenario analysis. This scenario presents a professional challenge rooted in the implementation of new data privacy regulations within a multinational corporation like Hutchison Holdings. The core difficulty lies in balancing the operational imperative to leverage data for business insights with the stringent legal and ethical obligations to protect customer privacy. Specifically, the challenge involves interpreting and applying the General Data Protection Regulation, GDPR, across different business units and jurisdictions where Hutchison operates, ensuring consistent compliance despite varying local interpretations or enforcement priorities. The need for a robust, yet adaptable data governance framework that respects individual rights while enabling legitimate data processing is paramount. Correct approach analysis. The correct approach involves establishing a comprehensive data governance framework that is explicitly aligned with GDPR principles. This framework should include clear policies on data minimization, purpose limitation, accuracy, storage limitation, integrity, and confidentiality. Crucially, it necessitates the appointment of a data protection officer, DPO, with sufficient expertise and independence to oversee compliance. The process should involve conducting data protection impact assessments, DPIA, for high-risk processing activities, implementing robust security measures, and ensuring mechanisms for data subject rights requests are in place and effective. This approach represents best professional practice because it proactively addresses GDPR requirements, demonstrating a commitment to lawful and ethical data handling. It fosters trust with customers and stakeholders, mitigates legal and reputational risks, and ensures that data processing activities are conducted in a transparent and accountable manner, as mandated by Articles 5 and 32 of the GDPR. Incorrect approaches analysis. One incorrect approach would be to adopt a minimal compliance strategy, focusing only on the most obvious and easily rectifiable breaches of GDPR. This is professionally unacceptable as it fails to embrace the spirit of the regulation, which emphasizes a proactive and risk-based approach to data protection. It risks overlooking subtle but significant violations, leading to potential fines and reputational damage. Ethically, it demonstrates a lack of commitment to safeguarding individual privacy. Another incorrect approach would be to delegate data protection responsibilities solely to IT departments without adequate legal or compliance oversight. While IT plays a crucial role in implementing technical safeguards, data protection is a broader legal and ethical responsibility that requires expertise in data privacy law, risk assessment, and stakeholder engagement. This approach fails to ensure that data processing activities are lawful from a legal perspective, and that the organization's overall data handling practices are compliant with GDPR principles of accountability and fairness. A third incorrect approach would be to assume that compliance in one jurisdiction automatically translates to compliance in all others where Hutchison operates, without conducting specific assessments for each. GDPR has extraterritorial reach, but its application can be nuanced, and local laws may impose additional or different requirements. This approach is professionally flawed as it ignores the potential for differing interpretations and enforcement, increasing the risk of non-compliance in specific markets, and failing to uphold the principle of accountability under Article 5(2) of the GDPR. Professional reasoning. Professionals faced with implementing data privacy regulations should adopt a systematic and risk-based approach. This involves 1. Understanding the specific regulatory landscape, e.g., GDPR and any relevant local data protection laws. 2. Conducting a thorough audit of current data processing activities to identify potential risks and compliance gaps. 3. Developing and implementing clear, actionable policies and procedures that align with regulatory requirements and ethical best practices. 4. Ensuring adequate training and awareness for all relevant personnel. 5. Establishing robust monitoring and review mechanisms to ensure ongoing compliance and adapt to evolving regulations. 6. Seeking expert legal and compliance advice when necessary. This structured decision-making process prioritizes proactive risk management, ethical conduct, and sustained compliance. Question 19. Compliance review shows that a client has expressed a strong desire for investments that promise exceptionally high returns within a short time frame, citing a need to fund a significant upcoming purchase. However, the client's financial profile indicates a low tolerance for risk and limited experience with complex financial products. What is the most appropriate course of action for the financial advisor? Option A. Conduct a detailed assessment of the client's financial situation and risk tolerance, and then engage in a discussion to understand the rationale behind their aggressive return expectations. Based on this, propose alternative investment strategies that align with their risk profile while still aiming to meet their financial goals, explaining the trade-offs involved. Option B. Immediately proceed with the client's requested high-return investment strategy, as their stated objectives are paramount and the firm should facilitate their financial desires. Option C. Focus on presenting a selection of the highest-performing investment products currently available, emphasizing their potential for rapid growth, and allow the client to choose based on their own research. Option D. Politely inform the client that their investment objectives are unrealistic given their risk tolerance and financial capacity, and suggest they seek advice elsewhere if they are unwilling to adjust their expectations. The correct answer is A. Conduct a detailed assessment of the client's financial situation and risk tolerance, and then engage in a discussion to understand the rationale behind their aggressive return expectations. Based on this, propose alternative investment strategies that align with their risk profile while still aiming to meet their financial goals, explaining the trade-offs involved. Explanation. Scenario analysis. This scenario presents a common challenge in financial services where a client's stated investment objectives appear to conflict with their risk tolerance and financial capacity. The challenge lies in balancing the client's desires with the firm's fiduciary duty and regulatory obligations to ensure suitability. A failure to adequately address this discrepancy could lead to mis-selling, client dissatisfaction, and regulatory sanctions. The professional must exercise judgment to identify the root cause of the conflict and propose a solution that aligns with both the client's best interests and regulatory requirements. Correct approach analysis. The correct approach involves a thorough investigation into the client's stated objectives and a detailed assessment of their risk tolerance and financial situation. This includes probing questions to understand the rationale behind their aggressive return expectations and exploring alternative strategies that might achieve similar outcomes with a more appropriate risk profile. This aligns with the principles of Know Your Customer, KIC, and suitability, which are fundamental to regulatory frameworks such as those overseen by the Financial Conduct Authority, FCA, in the UK. The FCA's Conduct of Business Sourcebook, COBS, mandates that firms must ensure that any investment recommendation or decision to trade is suitable for the client. This requires understanding the client's knowledge and experience, financial situation, and investment objectives. By prioritizing a deeper understanding and offering tailored advice, the firm upholds its fiduciary duty and adheres to regulatory expectations. Incorrect approaches analysis. One incorrect approach involves immediately proceeding with the client's requested investment strategy without further inquiry. This fails to meet the suitability requirements mandated by regulations. It demonstrates a lack of due diligence and a disregard for the client's overall financial well-being, potentially exposing them to undue risk. This could be seen as a breach of the duty of care and a failure to act in the client's best interests, which are core ethical and regulatory principles. Another incorrect approach is to dismiss the client's objectives outright and refuse to engage further. While the objectives may be unrealistic, a complete refusal to explore alternatives or educate the client is unprofessional and unhelpful. It fails to uphold the firm's role as a trusted advisor and could lead to the client seeking advice elsewhere, potentially from less reputable sources. This approach neglects the opportunity to guide the client towards more appropriate financial planning. A third incorrect approach is to focus solely on the potential for high returns without adequately addressing the associated risks. This prioritizes a short-term gain for the firm or client over long-term financial stability and could lead to significant losses for the client, resulting in regulatory scrutiny and reputational damage. It ignores the fundamental principle of risk management and the need for a balanced investment strategy. Professional reasoning. Professionals should employ a structured decision-making framework that begins with a comprehensive understanding of the client's situation. This involves active listening, asking clarifying questions, and gathering all relevant information. Once a potential conflict is identified, the next step is to analyze the underlying reasons and explore various solutions. This analysis should consider regulatory requirements, ethical obligations, and the client's best interests. The professional should then present a range of suitable options, clearly explaining the risks and benefits of each, and empower the client to make an informed decision. Continuous monitoring and review are also crucial to ensure ongoing suitability. Question 20. The monitoring system demonstrates an unauthorized access event to a database containing client investment portfolios and personal identification information. The system logs indicate that the access originated from an internal IP address, but was not performed by an authorized user with a legitimate business need. What is the most appropriate immediate course of action to address this potential data breach? Option A. Inform only the IT security team to investigate the technical anomaly without involving compliance or legal. Option B. Immediately isolate the affected database, preserve all relevant logs and system data for forensic analysis, and initiate the firm's internal data breach response protocol, including notifying the compliance and legal departments. Option C. Assume the access was a system error and monitor the database for further unusual activity without taking immediate investigative steps. Option D. Delete the suspicious log entry to prevent any record of the unauthorized access from being retained. The correct answer is B. Immediately isolate the affected database, preserve all relevant logs and system data for forensic analysis, and initiate the firm's internal data breach response protocol, including notifying the compliance and legal departments. Explanation. The monitoring system demonstrates a potential breach of client confidentiality and data protection regulations, a critical area for financial institutions. The challenge lies in balancing the need for effective internal oversight and risk management with the stringent legal and ethical obligations to safeguard client information. This scenario requires a nuanced understanding of data handling protocols, consent requirements, and the specific provisions of the relevant regulatory framework, which for this assessment is assumed to be the UK's Financial Conduct Authority, FCA, handbook and relevant data protection laws like the UK GDPR. The correct approach involves a thorough, documented investigation that prioritizes client privacy while adhering to regulatory mandates. This includes immediate containment of the issue, a detailed assessment of the scope of the breach, notification to relevant parties, including regulators if required, and implementation of remedial actions to prevent recurrence. This aligns with the FCA's principles for businesses, particularly Principle 10, Customers' Interests, and Principle 11, Relations with Regulators, as well as the data protection principles under UK GDPR, such as lawfulness, fairness, transparency, and accountability. Best professional practice dictates a proactive, transparent, and compliant response that minimizes harm to clients and upholds the firm's integrity. Incorrect approaches fail to meet these standards. One incorrect approach might be to simply delete the data without further investigation. This would be a regulatory failure, as it bypasses the requirement to understand the nature and extent of the breach, potentially leaving systemic vulnerabilities unaddressed and failing to comply with data breach notification obligations. Another incorrect approach could be to inform only senior management without initiating a formal investigation or considering regulatory notification. This is ethically problematic and a regulatory failure because it obstructs a proper, documented response and may violate mandatory reporting requirements, demonstrating a lack of accountability and transparency. A third incorrect approach might be to assume the data is not sensitive and take no action. This is a severe regulatory and ethical failure, as it demonstrates a disregard for data protection obligations and a lack of due diligence, potentially exposing the firm to significant penalties and reputational damage. Professionals should approach such situations by first activating their firm's incident response plan. This plan should outline clear steps for investigation, containment, communication, and remediation. Key decision-making factors include the nature of the data involved, the potential impact on clients, and the specific regulatory notification thresholds. A systematic, evidence-based approach, guided by legal and compliance expertise, is essential to ensure all obligations are met and that the firm acts in the best interests of its clients and in accordance with the law.